Navios Maritime Partners, ticker NMM, just absolutely crushed Q2 2026 consensus. I mean, EPS came in at $4.65 and revenue hit $410.2 million. That is up a massive 25.2% year over year. Plus, management dropped guidance featuring the staggering $4.4 billion contracted revenue backlog. And, well, the market loved it. The stock jumped over 3% to near 52-week highs.
Yeah, it was a massive report. We've got their Q2 earnings, the conference call transcript, and a bunch of fresh institutional analyst notes on the table today to go through.
Right. And our mission for this deep dive is to really unpack what's driving those segment details, the exploding margins and management's capital allocation strategy. We're going to show you exactly how NMM is basically monetizing global supply chain volatility right now. Let's start with the segment performance, because the pricing power they have is just wild.
It really is. The absolute engine behind these numbers is the surge in time charter equivalent, or TCE, rates. Across NMM's fleet, those combined rates jumped 24% to over $28,000 per day.
Wait, $28,000 a day average? That's insane.
It is. But the real standouts were bulkers, which saw this massive 53% spike to almost $23,100 a day. And then tankers were up 25%, pulling in over $33,000 daily.
Okay, so let's unpack why that matters so much for the bottom line. Because shipping is, it's a business with massive fixed costs.
Right, absolutely.
You have to pay the crew and cover the maintenance and financing, whether that ship is completely full or just sitting empty. But once a vessel actually crosses its break-even point, almost every single extra dollar from these daily rate spikes drops straight to the bottom line.
Exactly. It's a textbook masterclass in operational leverage. Because those daily rates surged so hard, NMM's net profit margins widened significantly. They went from 23.3% up to 30.3%.
Wow.
Yeah, and that underlying efficiency is what drove their net income up an incredible 140% to nearly $168 million.
Okay, but here's where I want to push back a little bit. Looking at their fleet renewal strategy, it kind of feels like they're trading in a high-mileage used car at, peak shortage prices just to finance a brand-new hybrid fleet.
Oh, that's a good analogy.
Right. Because older ships are way less fuel efficient, and they face much stricter environmental regulations. So, are these massive margins just a temporary geopolitical windfall? Or has management actually built a sustainable machine here?
Well, I mean, that is the million-dollar question. What's fascinating here is how the CEO, Angeliki Frangou, is actively using this chaotic window to de-risk the company. They aren't just sitting back and collecting these high daily rates.
They're actively making moves.
Exactly. They're aggressively rotating assets. They recently sold off these 16-year-old vessels at 18% above historical peak prices.
Selling old assets at a massive premium to buy new tech.
Precisely. They're using that premium to fund new scrubber-fitted ships.
And scrubbers are crucial because they literally clean the ship's exhaust gases.
You got it. That allows these new vessels to burn cheaper, non-compliant fuels. It permanently lowers operating costs and structurally boosts their margins, regardless of where those daily shipping rates end up sitting.
Plus, they are aggressively cleaning up the balance sheet with that cash flow at the exact same time. They dropped their net loan to value from 45% back in 2022 down to just 27.9% today.
Which is a huge drop. And they also just doubled their unit buyback authorization to $200 million. If we connect this to the bigger picture, it just shows immense financial discipline. They are using a peak cyclical market to deleverage and create a massive financial buffer.
Okay, that financial buffer is impressive, sure, but isn't it entirely reliant on global chaos? I mean, if peace breaks out tomorrow and trade routes normalize, what happens to this pristine balance sheet?
You are definitely right to call that out. The macro risks are heavily tied to this performance. This whole current windfall relies on geopolitical choke points and disruptions remaining active.
Like the situation in the Red Sea or the Strait of Hormuz.
Yeah, to give you an idea of how extreme this gets, during that recent Strait of Hormuz closure, rates for VLCCs, those very large crude carriers, the massive supertankers, they briefly spiked to an incredible $602,000 per day.
Over $600,000 in a single day. That is definitely not normal.
No, not at all. Tariffs and shifting trade routes are just constant, unpredictable variables.
Right. So why does this specific earnings report matter to you as a retail investor? Mainly because NMM is showing us a masterclass in how to use cyclical, chaotic markets to repair a balance sheet and secure immense long-term cash flow visibility. They have already fixed 77% of their available days for the second half of 2026.
Which, leaves us with a really important strategic question to mull over. NMM is currently thriving on global fragility. But if geopolitical tensions do cool down and global trade normalizes, does their ultimate defensive hedge, that $4.4 billion contracted backlog, does that turn into a straitjacket?
Oh, like it completely caps their future upside because they're locked into older rates.
Exactly. It's a very real risk to consider if rates stay elevated, but they are stuck in legacy contracts.
Yeah, there's a fascinating trade-off between security and potential. Make sure to follow the show for daily earnings coverage to stay ahead of the market.